Market news now. Crude oil is holding above $90 a barrel. Asian equities are down and the safe haven dollar is firm amid heightened anxiety over escalating violence in Gaza and the prospect of the conflict could be spreading to areas beyond Israel. But meanwhile, Japan's Nikkei fell as much as 2%, while Hong Kong's Hang Seng Index slipping 0.4% and mainland blue chips dropping 0.6%. The benchmark 10-year U.S. Treasury yields are edging up 4.6% after more than 8 basis point decline amid demand for the safety of bonds. Meanwhile, locally, affordable housing and memorial parks developer Calgro M3 reported that revenue rose 13.5% despite selling fewer units as sales prices improved. The company, that's valued at about 550 million rand on the JSE, did not declare an interim dividend as management opted to hold on to the money to fund possible growth. To give us more perspective on the markets, we are joined by Gary Booysen, who is a portfolio manager at Rand Swiss. Gary, thank you so much for your time. Your take on market sentiment, especially following the moves that we saw last week. How have we kicked off this new week?
So pretty optimistic. I think local markets maybe we're watching the rugby. So we've got the top 40. Okay, it's flat. It's marginally up, but the resource index really leading the upside this morning. Currently up around say 1/3 of 1%. The local currency really benefiting, coming down to around 18.80 to the dollar. I think part of that is that lift that we're seeing in resources, the likes of our gold counters, maybe helping to shore up the move in the underlying currency. Across in Europe, we've seen a negative start. So we've got both Germany and France down, but we do have the FTSE 100 bucket trend up around 4/4%, and that also just being led higher by the likes of Glencore, Rio Tinto, Shell. So also coming from the resource complex. Overall, a lot of data coming out this week. We obviously had some of the banks reporting for the kickoff of US earnings season. So I think a lot of data to come.
So speaking of those banks having kicked us off on Friday, what has been the key takeaways so far when you look at those numbers coming out of the likes of Wells Fargo, etc.?
So far, surprisingly good. So I think a lot of people were expecting the deterioration certainly in the bank's earnings to be more aggressive, to see the higher interest rates and the higher fees that many US consumers are paying on products like credit cards and other debts to really be biting into bank earnings. But that really isn't the case. We have had some warning signs. There are signs that the banking consumers' behavior is becoming a little bit more cautious. We've seen a depletion in US consumer savings. But it hasn't fed through to the bottom line at the banks. And I think that is a positive surprise. We saw most of the banking stocks up on Friday, but there is definitely a sense that this situation can't last forever, that there is going to be a slowdown. The slowdown in the US is coming. It's just not here yet.
Sticking with the banking theme, let's focus on our local banks. I mean, what's front and center for bank investors when you look at some of our banks?
Well, I think it's the underlying economy. There's no question about that. Our banking stocks are very, very cheap. We've seen Standard Bank performing exceptionally well, but the rest of the banking sector coming off a little bit. And I think it's really around growth concerns. So we obviously have our CPI figures coming out on Wednesday. Core and headline inflation is expected to come in at 4.8%. The governor has been very clear, saying that interest rates and central bank policy, which is obviously administered through the large banking institutions, can't fix the local economy, and it really is up to all the other mechanisms as well. And high interest rates can only do so much. But overall, our banks are cheap. They're well capitalized. We've seen a big lift in the ROE at a lot of the local banks, and they remain cheap. So I think good quality businesses just suffering from a very, very difficult consumer environment domestically.
We have Pick n Pay releasing their results on Wednesday. What will you be looking out for?
So we had a fairly decent, fairly detailed, at least, trading update from Pick n Pay on the 2nd of October, and obviously Sean Summers coming in as the acting CEO now as well. So we have quite a detailed expectation of Pick and Pay. We're expecting earnings to absolutely collapse. They're going to swing into a loss. This was all announced. So when the market sees it, let's hope the market isn't too surprised by what it's seeing, since it has been fairly well telegraphed to the market. We're expecting earnings per share to drop drop at least 98 cents, between 79 and 98 cents. This is from a profit of 94 cents in the first half of 2022. And really, the company has cited all sorts of reasons for this fall. A delay at the Longmeadow and Eastport DC, so distribution center handover. Obviously, load shedding. It affects all retailers, and then of course they're restructuring as well. But really, if you're looking at the entire market, it's also very, very strong competition from the likes of ShopRite, and we're seeing that in their volume decline. So again, from the trading statement and what we're expecting to see in the results on Wednesday is selling price inflation at 8.3%, but sales increases of only 0.3%. So, a big decline in volumes is what we're expecting. And I think what we want to hear from the new CEO is how the ship is going to be turned around.
What cues do you get when you look at headlines that read, foreign investors have accelerated their net selling of local equities, or at least equities on the JSE? How do you interpret that?
It's an interesting question. So, obviously, I think it's largely to be expected. We understand the pessimism around the South African economy, but I think it's important when you're reading a headline like that to put it in context. A lot of the foreign investors, certainly in JSE listed securities, are portfolio-based investors, and a lot of it is passive money as well. So when you get what we're getting at the moment, we're getting a rise in geopolitical tensions. There's the sense that we're moving into a more risk-off period. The decision on many of these big passive funds, and when I say decision, I'm going to put that in air quotes, is to sell out of risky emerging market stocks. And there's broad-based selling across an exchange like the JSE. It's not necessarily specific to the JSE companies because it is a passive flow.
Yeah.
At the same time, I think what you're asking this question is who is the smart money as well? So, if you see the foreigners are selling, are they more smart than domestic sellers? And, I think history, and if you look at some of the hedge funds in South Africa, certainly, there's some very, very savvy domestic players. And generally, it is the perception among active market participants that the foreign money is a little bit behind. So the idea is that when you see a stock overvalued, the domestic investors sell out first. We're the ones with the feet on the ground, and we kind of have a much better access to a lot of these companies than the big foreign players. And then once we've sold out, you almost see the foreign sellers coming in after that. So if I see a headline that says foreign sellers are selling JSE equities in record volumes, that for me is definitely an opportunity. It tells me that we're getting to a stage where valuations are becoming more compelling, and it might be time to swing long.
All right. On that note, Gary, thank you so much for your time. Let's leave it there. That is Gary Booysen, who is a portfolio manager at Rand Swiss.